My dear, in the continuation of the evaluation of long-term security, we in early video we discussed the valuation of common stock while using the dividend discount model approach. Further, we are today going to discuss evaluation of the equity while using the concept of the operating cash flows. Similarly, as I discussed earlier, that by valuation we mean the discounting or finding out the present value of the expected cash flows. In this case, we are going to find out the present value of the expected cash flows, but these cash flows are now in shape of the operating cash flows. So in this case, one thing is important that we are going to learn is that in dividend discount model we used to discount the cash flow, that is dividend, by the required rate of return on equity, while in this case in operating cash flows we used to discount the cash flows by using the weighted average cost of capital as a required rate of return on investment instead of the KE. This weighted average cost of capital, in term of the company they have called it the cost of capital, while in term of the investor we used to call it the required rate of return on investment. Now this investment is actually done by the through the preferred shares, through the common shares, and through the corporate bonds. Now the question arises, why we are using the weighted average cost of capital as a discount rate, why not only cost of equity? My dear, when we find out the operating cash flows, let me share its framework. Look, for this is the how we find out the operating cash flows. It is different from the income statement, as it only consider those transactions which are done on cash. These are only cash based record, like sales. For example, if there is a project of the 5 year, so we are going to expecting that we will receive the cash inflows till the 5 year. So sales, cost of goods sold, then it equal to the gross profit. We deduct the operating expense and we deduct the depreciation which come under the operating expense. It result in the operating cash flows, or we call it in income statement, we call it operating profit. We deduct the tax, and then as you can see that we are again going to add the depreciation. The reason for adding the depreciation is that depreciation is a non-cash expense. Like in case of the once depreciation is occurred, if you see the journal entry of the depreciation, we debit the depreciation expense and credit the decrease in the asset. So my dear, that is why we add it again, that because it is not the cash based expense. So if we are going to add it, then why we deduct it? So this is the second question. We deduct it to get the benefit of the tax. Once we deduct it, it reduces the operating cash flows, and when there is low operating cash flows, we are supposed to pay the low tax. Okay, my dear, once we have added the depreciation again, then we subtract the change in working capital if it occurs in this time period, and then we deduct the change in fixed asset if it occur in this time period. My dear, it result in the net operating cash flows. So at this time, if you see, we didn't deduct any interest, and we didn't deduct any preferred share dividend, and even we didn't deduct any common share dividend. So this value of operating cash flows, the three different kind of investors, preferred shareholder, common shareholder, and bondholders, all these three have they have claim on this value. That is why we used to discount the operating cash flow while using the WACC instead of the KE only, the required rate of return on equity. So WACC represent the required rate of return of all the investors. This is the average required rate of return of all the investors. So that's why, my dear, we used to discount the operating cash flow while using the value of the WACC. And this is the formula of the intrinsic value or the present value of the operating cash flows. If we have, for example, 5, operating cash flows, we will discount each operating cash flow by the WACC. To simplify it, we can write it in this way, that this is the present value of the operating cash flows discounted by the value of the WACC. Now my dear, once we got the intrinsic value or the present value of the operating cash flow, we then deduct the debt amount. The amount left, that is the only claim of the shareholder, and we distribute that only among the shareholders. So this is the simplified formula of the operating cash flows, the discounted or the present value of the operating cash flows. Simply you can see that the summation of the operating cash flows divided or discounted by the WACC. Now my dear, if there is investment in a project which can give you a cash flows for a long period, we can use the similar concept of the dividend discount model. If there is the constant cash flows, we can use the perpetuity concept as we use in the zero growth dividend model. And if there is a constant growth rate in the cash flows, and we are supposed to find out the present value of the cash flows forever, then we can use this method as we use in the dividend discount model. Operating cash flows divided by WACC minus G. G is the growth rate, WACC is the discount rate or the required rate of return of the investor, and these are the future cash flows. And similarly, if there is a phase growth, so you may check out the previous video where we discussed the dividend discount model while using the phase growth model. The same concept can be applied here also. If you have different phases of the growth, so we can assume several different rates. The same thing, the same concept is covered in the dividend discount model, so you are supposed to go through that video. Normally the last concept is the finding out the intrinsic value of the shareholders while using the free cash flows. By free cash flow, and what is the difference between the operating cash flows and free cash flows? In free cash flows, actually it only presents the amount that is available to the shareholder. We used to deduct the interest and principal amount from the operating cash flows. Like in previous case, we didn't deduct the interest there, that is why we discount it on the WACC. But in this case, we have deducted the claim of the bondholders, so that is why we will discount it while using the concept of the cost of equity or the required rate of return on equity instead of WACC. Why WACC? Why not WACC? Because there is no claim of the any other investor except the equity holder. So formula in this case is that we are supposed to find out the present value of the free cash flows while discounting it on the KE or the cost of equity. So you can see that in free cash flow we deduct the interest and the principal amount. Once that is deducted, only we are left with the equity claim. So that is why we used to discount it on the required rate of return on equity only instead of the WACC. You can see from here also it is the same picture. Hopefully you got it. If you have any question, please write it in the comments.